Feeling stuck trying to figure out where to put your money? Thinking face. You've heard of EverBank and you're looking to invest, but what's the deal with their investment account versus a standard brokerage account? Are they the same thing? If not, which one is right for your financial goals? It's a common point of confusion, especially when banks offer a range of products. The key difference comes down to what you're trying to achieve with your money. The EverBank Investment Account, think cash management. When EverBank talks about some of its core investment products, they often include high-yield deposit accounts like their Performance Money Market Account or Certificates of Deposit, CDs. These are accounts where your money is focused on safety and fixed returns, or interest. Safety first, these are generally FDIC-insured accounts. This means your money is protected up to the legal limit, offering a very low-risk way to grow your cash. Purpose, they're primarily for saving and cash management. They're the perfect spot for your emergency fund, money you plan to spend in the next year or two, or simply cash you want to keep liquid and secure while earning a competitive yield. Accessibility, you often get easy access, maybe even a debit card or check writing privileges, making it easy to use your cash when you need it. In short, an EverBank investment account, in the context of these deposit accounts, is about preserving capital while earning interest. The brokerage account, think growth and trading. Now, a standard brokerage account, which EverBank, through its partnership with TIAA, also offers, is a whole different ballgame. This is your direct access to the market. Growth potential, a brokerage account is designed for investing with the goal of significant long-term growth. This is where you put money you won't need for several years. Investment choices, this account holds actual investments like stocks, bonds, exchange-traded funds, ETFs, and mutual funds. You are the one choosing what to buy and sell. Market risk, unlike the fixed interest of a money market, your returns are based on market performance. That means the potential for higher returns, but also the risk of losing principal. This is why brokerage accounts are generally covered by SIPC insurance, which protects against the brokerage failing, not against market losses. The brokerage account is essentially your tool for wealth building through active market participation. So, if you're looking for a safe harbor for your cash to earn a solid yield with easy access, think EverBank's money market. But if you're ready to take on market risk for the potential of higher, long-term returns by building a portfolio, you need a brokerage account. Choosing the right account is all about matching the tool to the job. Use the deposit account for your short-term needs and the brokerage account for your long-term investing goals. With that said, thanks for watching and until next time.